Your credit score controls more of your life than you actually realize. And most people don't really understand how the credit score works, how to improve it, how to build it, how to get to the actual 700 destination that we all want. But in today's video, I'm going to explain it to you in plain English and how simple it is and what's important in building your credit score. And you may even know one of these factors is not as important that you may think it is, and you may have been stressing about it this whole time. But what exactly is a credit score? Your credit score is simply this. It is a risk score. It is when a bank decides, hey, do I want to give you money? How much risk are we actually taking? Are we going to make it back? Some even say it's a debt score. I don't know if I always agree with this, but I think at the end of the day, they're asking you this simple question is, okay, hey, I want to give you this money, Cameron. Can I trust you? If I give you this money, can I trust that you're going to give it back to me in a timely manner? Or another question they could be asking is, how likely is this person going to pay us back? And that's really what your credit score kind of tells. Now, you may be a very honest, very, integral person, and you feel like, hey, I always keep my word, but your score is really their indicator to know that you're that person. So I know that you may say, I've never lied to anybody. I've never been late on a payment on any other, but if your credit score reflects otherwise, that's all a bank really is going to go off of, because it's data, right? It's not necessarily your word against theirs. It's, hey, in their proven history, they've shown this. And so today I'm going to tell you what the 5 most important factors are for your credit score. But before I do that, make sure you like this video, subscribe to the channel, and tap in and get more financial content just like this. So what are the 5 important factors of your credit score? Well, the first one is going to be your payment history. I'm going to go through each one in detail, but this one is simply 35% of your score. So this has the most weight. It really matters the most to banks and lenders in Experian, Equifax, TransUnion. They want to know, are you paying on time? But the next one is going to be credit utilization. How much of your credit are you actually using? That's 30% of your credit score. And then we have the credit history, which is going to be 15%. So how long have you had credit? And then next is going to be credit mix, which is going to just be a mix of different types of lines of credit that you may use. 10%, so not really a big deal, but also something that you should pay attention to. And then we've got hard inquiries, which is going to be 10% as well, which is basically how many times you get your credit actually pulled. So let's jump into the first actual factor, and that's going to be payment history. And so 35% is really based on you saying, hey, I'm going to pay my bills on time. So I've always said this, if you don't do anything, just make sure that you pay on time. Another saying that I've always said is auto pay is the way. And here's why I say this. If you put your things on auto pay, you can almost guarantee, as long as you have the money in your account, if you're using our Smart 7 system, you're going to make sure that that money is available. But if you're also just making sure that I know I'm going to pay on time because it's already automatic, life gets busy, you forget. Instead, if you just go ahead and put it on auto pay, you know that it's actually going to happen. So if you have a late payment, you have collections, this is going to hurt your payment history. And people probably don't know this stat a lot when it comes to credit. But if you miss one late payment, it would take 11 payments on time to replace the damage of you having one late payment. So this is why it's important. Even if it's the minimum and you don't make any traction, you have to pay some interest, just pay it on time. I can't stress that enough. It's 35% of your score, which is really about 280 points of your actual score. So you want to make sure that you do that. And then the next factor brings us to credit utilization, right? This is 30% of your score. And this is a simple question you want to ask. How much of your card are you actually using? And so really how banks look is, okay, we gave this person a lot of credit, but now they're using so much of it that kind of comes off to them very irresponsible. So if I give you $50,000, then you use $49,000 of it and you're not paying it back or you're making the minimum, that's not really a good sign. Because at the end of the day, a bank is looking at how you actually steward the money. It's not necessarily, okay, we gave it to you, you're building a business, that's great. But are you paying down debt, or are you using so much of it and maxing out? And do you have the money to actually pay out this high amount of credit that you've actually used? So here's a very safe point that you should look at. The goal should be 30% at least, but the standard for you, and ideally, you want to stay at about 10%. So if you want to know an example of what that looks like for simple math, if you have $1,000 credit limit, you want to keep your balance at $100. You're like, oh, Cameron, what am I supposed to do with $100? Maybe not too much, but here's the thing that you need to make sure as well that I think is important when it comes to, I should have said this earlier, but when you're using a credit, paying it on time, and you need to make sure that you are using it on your statement date. That is when you actually need to be paying your bill. not your due date. Your statement date is when it's actually reported. And so you want to make sure that if you're going to use your card, if you're going to utilize it a little bit more than the 10%, that your actual percentage when it shows on the statement date that you've already paid your debt down. So let's say your statement date is on the 10th of the month. If you're going to use your card from the 11th all the way up until the 8th, I would say the 8th and give you 2 days, just so if you want to make a payment, you give it time to process. But if you want to run your utilization up and then you know you're going to pay it back, just make sure that it's paid down and you've paid majority of your credit card down by the time you get to your statement date. So when it is reported, it does not hurt your score. But here's I guess a trap. If you make a lot of money, you have high income. This is why a lot of people have lower scores, because they feel like, okay, I make good money, I can have a higher utilization because I can pay it off. But this typically with clients I work with who have higher paying jobs or they make a lot of money, high net worth individuals, sometimes they don't have good credit score because they may have $50,000 in debt and their utilization may be 98%, but they feel like, hey, I can always pay this off. So that's something that kind of you don't really want to get into, because still, why use your money when you can use the bank's money, especially if you're in the business world, to help you be able to scale, leverage your business, and make money and not have to pay so much out of your own pocket. So just keep that in mind, is that you still want to keep your utilization under 30% is really your first target. The next thing we want to jump into is credit age. Now, this is 15% of your score, but if I had to give you one thing, I would say is do not close your cards. This is always a question I get asked, like, hey, I don't use this card anymore. Should I close it? Well, here's the reason why I think it helps you. If you have a card maybe at a Belk or some type of, department store that you got it, even though you may not even go there to shop, but you've had it for 10 years, right? Well, let's say you've got a lot of newer credit cards that are maybe 3 or 4 years. Well, if you get rid of your 10-year card, now your credit age is now lower. And so what does that mean to a lender? That means it looks in their eyes as if you haven't had a lot of experience with credit, or you've only used it for maybe a couple years, versus if you're showing that you've had credit for 10 years, they know that you're experienced. And that also means that if your score is 700 or 600, they know that you've sustained that, or hopefully it's been good for that amount of time frame. And so you want to make sure that you use it. So my challenge to you is, even if you have a, let's call it a Belk or some type of department store, even if you go buy some socks or buy something that you really use but you don't really need all the time, just use it every 6 months just to let them know that you're actually using it. And then at the end of the day, credit bureaus, they want to know that you're being consistent. So they don't want to know that you're going to reset things and you're going to close this card and start over again. Just be consistent. And if you have 10 years of credit age and good credit health, then you want to make sure that you're showing them that by keeping your credit cards open. Now, I'm not saying just go spend it just because you should, but just be reasonable about actually using your cards. The next thing is credit mix. This is a very simple thing. This is 10% of your score, so really about 85 points. This is credit cards, loans, your mortgage. And here's the rule that I like to give to a lot of people is the 3-1-1. You maybe should have 3 credit cards, maybe one, let's call it installment loan. So that could be a car loan, maybe a personal loan, and a mortgage. Now, you don't have to go get these things if you don't have them now. But I'm just saying, if you want to have a really balanced credit mix, then you should go get these 3. So that's going to be 3 credit cards, 1 installment, whether that's a car loan, a personal loan, something of that nature that's going to show that you are paying things on time, but you're also balanced. You're very diverse in how you use your credit, because you're not just using it on one certain tool. So that's 10% of your score. It doesn't have a lot of impact, but it's just something that you want to keep in mind as you're building your credit. And then we've got hard inquiries, which is going to be 10%. This is probably the biggest mistake that a lot of people make, is they think that they can always apply for new credit all the time, right? But this, yes, it's 10%. But when you have the thing about hard inquiries and really the difference between hard and soft, right? Hard is going to be actually when they pull your credit and actually look and check your actual credit score. So a soft is going to be more of a pre-approval. So that's going to be, we're going to see how much you can actually afford. So we're not going to actually report this to the bureau and it drops off immediately. A hard inquiry is going to be something that stays on there for 2 years. And so this may hurt you a little bit if you keep it on there. But you don't want to look. You don't want to have too many accounts, because at the end of the day, that is a red flag to them when you have too many accounts that you've applied for and you're not getting approved. So it's like, hey, what's going on? To them, it's almost like panic mode. It's like, are they trying to find money? Are they applying for all this credit so they can get out of a situation? That's what it looks like to a lender. And so you don't want to continue to just do it just to see if you can get more credit. You need to be very strategic about how you're applying for credit cards. And then also there are certain cards, certain loans that all are on the same bureau. So you kind of want to take a look and see what resources you can find and like what credit union or what credit bureau do they actually pull for. Is it TransUnion, Experian, or Equifax? All these things are very important. And so these are really the 5 most important factors when building your credit. But I also want to touch on this last part. I want to talk about some credit myths that people think that they've heard. Hey, this is some things I've heard about. And myth number 1 is simply this: having a zero balance actually helps your score. This sounds really crazy. You're like, what do you mean having a zero balance doesn't help? Well, if you actually look at the FICO scoring method, if you keep 5% on your actual card just to show them that you're actually using it, it actually gives you the most amount of points that you can get. But when you have a zero balance to a credit bureau, it looks like you're not actually using the card. Now, I know this is probably not ideal because it's like, wait, are you telling me I should leave money on my card? Yes and no. I would say you would leave the money. So say if you have $1,000 limit, right, and your utilization is 10%, and let's say we say 5% in this case. Let's say you leave $50 on your card just to show that 5% is being used. Now, when it's shown, you can, after the statement date, you can pay it off. But you need to show the bureau that, hey, I'm actually using this so you can get the most amount of points from having a good utilization rate. So this sounds really crazy because it's like, oh, well, I'm supposed to just leave all my money. No, you just need to be very smart and strategic about what you're doing. So that's the first myth that we're going to debunk. Myth 2 is going to be this: oh, if I close my cards. We've already talked about this, but if you close your cards, it's always going to help. And that's not simply true, because if you close them, your credit age is going to shrink. And so you want to make sure that you keep them open. Even if you aren't using them as frequently, just use them every 6 months, but you want to keep them open and not close them. That would be myth number 2 that we're going to debunk here. And the last myth, I get this question so much. Well, Cameron, I don't want to check my credit score because it's actually going to hurt my credit. Simply not true. Experian is free. Equifax is free. If you want to go to annualcreditreport.com, you can get a free report and learn everything that's on there, and it will not affect your credit score. Now, if you go apply for lending or a loan, that will affect you. But actually checking your credit score on any type of credit bureau is not going to hurt your score. So you want to just make sure that you want to actually stay in tune with where your credit is going when you get these alerts, or if you're not even checking, just knowing what it is, because once again, it does matter. It's basically your trust factor with these banks when you want to go get a mortgage, when you want to go buy a car loan. And people think, oh, it's not that big of a deal. The difference between 5% and 9% in interest is thousands of dollars. And depending on what type of asset you're buying, could be hundreds of thousands of dollars that you're missing and having to pay a little bit more on just because you didn't take care of your credit score. And at the end of the day, this is to wrap this up. Credit is simply a tool. I'm not the person who's going to say you should cut all your credit cards. Now, if you have spending issues, maybe that's something you should look at. But I actually think credit is something that can help you. You just need to know how to play the game. You need to understand that, hey, I can use this as something to benefit me, to help me. If you have all these credit cards that have benefits, I've gotten free flights, I've gotten free hotels, all because I've used my credit cards typically for things that I'm already going to pay for anyways, whether that's my utility bill, whether that's my phone bill. I use it for things that I already have. And with my business, I use it for things that are going to help us make more money. And then we're going to take that same money and pay back the bill. So if it's something, if you're a business owner watching this and you're wondering, should I only use cash? Sometimes, yes, but also there are instances if you feel like there's an opportunity you need to take advantage of, then why not use it to use the bank's money to be able to leverage your company, to scale it and build it the way that you want to. And so I hope this video was helpful for you. And if you want to get more content like this, be sure to check out these videos.